So right now, the U.S. government is quietly operating what is essentially a multi-billion-dollar fire sale on its own debt.
Mm-hmm.
Like they're stepping into the market and buying back bonds at roughly 60 cents on the dollar. And that single maneuver is triggering a massive, just an underlying earthquake across global financial markets.
Yeah, it really is. It's the defining dynamic of the market right now. We're
Mhm.
seeing a historic capital rotation. Money is shifting incredibly fast, and it's driven by, well, a combination of inflation fatigue, those specific Treasury maneuvers you just mentioned, and of course the looming shadow of mega cap tech earnings.
Yeah, and that rotation is exactly what we're mapping out in today's deep dive.
Yeah.
We have an incredibly diverse stack of source material in front of us today.
Mm.
I mean, we're pulling from macro treasury data, political wildcard reports, hyper-specific day trading levels,
Oh yeah.
and even this private market data on a beverage startup that is actively taking massive market share from big soda.
Which is fascinating.
It is. So our mission today is to cut through the headline noise, identify the underlying mechanics of where the smart money is actually positioning itself, and really pinpoint the actionable trading levels in this shifting environment.
Right, because the goal here is to look past the surface level price action. We need to dissect today's most significant market moves, the unusual volume spikes, and the price action anomalies from a pure trading perspective.
Exactly, to understand the why behind the capital flow.
Yeah.
But really quick, before we unpack the political elements mentioned in today's sources, I just want to give a quick note to our listeners.
Big call.
Yeah, these sources touch on some pretty politically charged strategies from both the left and the right. So we are not taking sides or endorsing any viewpoints here. We are strictly and impartially reporting what is contained in the source material, just to understand their potential market impacts.
I mean, in the context of capital markets, political maneuvers are simply data points.
Right.
They're just variables that translate directly into volatility and, well, structural opportunity.
Exactly. So let's start with that volatility at the macro level, specifically this U.S. Treasury buyback operation.
Okay.
So the data shows the Treasury is increasing their buybacks of older debt, and they're heavily targeting the 10 to 20 and 20 to 30-year sectors.
Mm.
They've actually just doubled the maximum size of these operations from $2 billion to $4 billion. But the mechanics of this are what fascinate me because, the government obviously doesn't have a giant vault of surplus cash sitting around to buy back $4 billion in debt.
Definitely not.
Right. So they are issuing short-term debt, T-bills, to raise the cash and then immediately using that cash to retire the long-term bonds.
Yeah, the whole mechanism hinges entirely on the concept of the discount.
Okay.
Think of it like a homeowner trying to refinance a mortgage, but in reverse.
How so?
Well, imagine you have a 25-year bond that the government issued a few years ago when interest rates were, hovering around 2%.
Right, those super low rates.
Yeah. Exactly. Because current yields in the market have surged past 5%, nobody wants to buy that old 2% bond at full price.
Of course.
Its value on the open market has plummeted. So the Treasury realizes they can step into the open market and buy back that 14-year or 25-year bond for roughly 60% of its original face value.
Wow. So they issue $1,000 in new short-term T-bills, take that $1,000 and use it to retire roughly $1,600 in face value of their older long-term debt.
Precisely.
They are essentially operating a classic operation twist, a monetary policy move where you sell short-term and buy long-term debt to artificially flatten the yield curve.
Yep.
It reduces the total face value of the national debt and lowers their overall interest expense.
But,
The author of our macro source used a very specific, really vivid analogy here.
oh, the Band-Aid war.
Yes.
Yeah.
They called this operation, quote, putting a Band-Aid on a $40 trillion gunshot wound.
It's a dramatic way to frame it, for sure.
Yeah.
But it speaks to the sheer scale of the national debt versus the size of the actual intervention.
Right. Though I actually want to push back on the author's premise a bit there.
Okay, go ahead.
Because if the systemic liquidity pool is already overflowing, which, our sources indicate it is, does an Operation Twist-style buyback actually risk stoking inflation? Or is $4 billion literally just a drop in a $40 trillion bucket?
Well, see, that is the defining debate among macro funds right now.
Yeah.
Because in a tightly constrained, highly illiquid environment, injecting cash to buy back long-term debt would be highly inflationary, right? Because you're forcing new money into the system.
Makes sense.
But because the current liquidity pool is already flush, throwing another bucket of water in doesn't necessarily flood the house.
Oh, interesting.
What it does do, however, is artificially compress real yields on the long end of the curve. And mathematically, when real yields are suppressed, non-yielding assets like gold instantly become significantly more attractive to institutional capital.
Which is a perfect segue into the risk management data from 42 Macro.
Oh, yeah. This is crucial.
Because in an environment where yields are being artificially manipulated by Treasury buybacks, holding onto risk assets requires a very cold mathematical approach.
Very cold.
The statistical reality of market drawdowns outlined in their research is, it's sobering.
Mm-hmm.
Since 1928, the S&P 500 spends roughly 25% of its time down 30% or more from its all-time highs.
It's wild to think about.
And when you look at Bitcoin, being a high beta asset, meaning its price swings are historically much more violent and amplified compared to the broader market,
Right.
it spends 67% of its time down 30% or more.
Yeah. And those statistics, they completely dismantle that pervasive illusion that markets just operate on this smooth, perpetual upward trajectory.
Right. The whole stocks always go up thing.
Exactly. It exposes the inherent mathematical danger of that blind buy and hold through anything mentality.
Yeah, because the compounding math is just brutal. Like, if a portfolio suffers a 20% drawdown, the investor needs a 25% gain just to get back to their original break-even point.
Right.
But if they suffer a 50% drawdown, which, we saw across the board during the dot-com bust or the 2008 financial crisis,
Yeah.
they need a 100% gain.
They have to double their money just to get back to zero.
Just to get to zero.
And that mathematical reality is why professional traders focus almost exclusively on dynamic risk sizing rather than trying to perfectly time the market.
Okay, unpack that a bit.
So the goal of smart money isn't to buy the absolute bottom or sell the absolute top. The goal is to maintain a high net asset value, or NAV.
Right.
If you have a $10 million portfolio, a 1% gain creates $100,000 in new wealth.
Yep.
But if you mismanage risk and let that portfolio draw down to $5 million, applying that exact same 1% effort only yields $50,000.
Oh, wow.
The underlying engine of your compounding curve is just broken at that point.
Okay, let's unpack this with the source's basketball analogy, because I think it frames this perfectly.
A great analogy.
They say trying to pick exact market tops and bottoms is like a novice stepping onto a court and trying to exclusively shoot Steph Curry half-court shots.
Yes.
It's a low-probability fool's errand. Instead of trying to guess the bottom and, catch a falling knife, the data suggests waiting for the market to prove itself.
Mm-hmm.
In statistical terms, traders are actively choosing to accept a type 2 error. They're willing to risk a false negative like missing the very beginning of a valid rally in exchange for waiting for structural confirmation that a trend is actually reversed.
Because protecting the net asset value is paramount. And that defensive posture is incredibly relevant today because the political crosswinds that are actively whipping through the markets are creating a severe risk of capital destruction for anyone caught on the wrong side of the tape.
Okay, let's outline those political realities impartially, straight from the source reports.
Let's do it.
So on the trade front, there are proposed 50% tariffs on Canadian goods. The reports detail that trade talks between the U.S. and Canada collapsed at the 11th hour, with Canada walking away due to last-minute changes that excluded heavy-duty vehicles.
All right.
And the friction is palpable. Mark Carney is quoted in the text stating that the former president, quote, signs trade deals in pencil.
Yeah, that is a very vivid characterization of policy unpredictability.
Seriously. And simultaneously, on the legislative front, the sources detail that Democrats are preparing a massive wave of investigations and subpoenas.
Right, assuming they secure the House majority.
Exactly. They are targeting the Trump family's cryptocurrency ventures and various defense contracts. And furthermore, the reports note the DOJ is preemptively investigating claims of a rigged election before the voting even concludes.
So when you synthesize those data points, the market translation is simple.
Which is
profound uncertainty. When institutional capital models out a future involving instantly collapsing trade agreements and preemptive legal warfare over election integrity, volatility spikes.
Capital inherently flees uncertainty.
Exactly.
And that flight to safety, that explains the price action we're seeing in gold.
Yeah, 100%.
The institutional money is aggressively bidding it up. Looking at the day trading levels provided in the sources, gold is catching massive structural support right around the 428 to 436 level.
All right.
I want to look at the mechanics of that specific zone. Because it isn't just a random number, right?
No, not at all.
It's a historical distribution block where sellers previously overpowered buyers. But now that the price is broken above it, algorithmic trading programs are treating that previous ceiling as a concrete floor.
Right. It's acting as the ultimate safe haven while the macro and political landscapes are kind of fracturing.
Yeah, but that macro tension, the inflation, the tariff threats, the government debt, it eventually trickles all the way down to everyday consumer reality.
It always does.
Right. I want to pivot to the bin store case study from our sources because it provides this fascinating micro lens on exactly how strained the consumer is right now.
Yeah, that was one of the most revealing economic indicators in the entire stack of research, I think.
Absolutely. So the story follows Sharon and her husband, who opened this bin store on Valentine's Day in 2020.
What timing?
Right. They survived a brutal 60-day COVID closure immediately after opening. And when they finally unlocked the doors, they had lines wrapping around the block.
Wow.
The entire business model revolves around taking giant pallets of big box retail returns, like crock pots, kids' toys, tools, things that would normally just be written off and sent to a landfill,
Yeah.
and dumping them onto 12 massive tables. Every single item in the store is a flat $5.
But the crucial data point from Sharon's operation isn't the revenue model, it's the demographic makeup of her customer base.
Yes.
Yeah.
She explicitly noted that her customers aren't just low-income shoppers hunting for necessities. She's seeing people you would structurally assume are well-to-do lining up for $5 retail returns.
Right.
It strongly implies a significant portion of the middle and upper middle class are just quietly living paycheck to paycheck, using this secondary market to afford basic goods.
And that behavioral shift, that explains the erratic price action and fundamental weakness we are seeing in traditional large-cap consumer discretionary stocks.
Oh, that makes sense.
Right. If a demographic that historically drives high-margin retail growth is instead, lining up to dig through bins for $5 returns, then the traditional retail sector's forward earnings projections are entirely detached from reality.
Yeah, the consumer is just deeply squeezed by the structural inflation we outlined earlier.
Exactly. But the capital isn't just vanishing, it's rotating.
Right.
While traditional brick-and-mortar retail is stressed to the breaking point, growth capital is aggressively targeting hyper-specific, health-conscious consumer packaged goods in the private market.
Yes, and the standout example in the research here is Olipop.
Right.
This is a prebiotic soda startup founded by Ben Goodwin, and it is doing over $500 million in revenue while remaining fully profitable.
It's massive.
It is. They've built this massive valuation by targeting what they call the fiber gap.
Yeah, and the clinical data supporting their business model is staggering.
Like what?
Roughly 90% of Americans fail to consume the USDA's recommended 28 grams of fiber a day.
90%. Wow.
Yeah, which is a foundational driver of the modern metabolic health crisis.
Okay, here's where it gets really interesting to me, though.
Okay.
I look at this through the lens of current pharmaceutical trends, and I see a massive contradiction. We are living in the era of GLP-1 weight loss drugs like Ozempic and Wegovy, right?
Mm-hmm.
These medications fundamentally alter digestion and appetite. So logically, wouldn't a consumer on a GLP-1 just stop drinking soda entirely? You'd assume a soda brand, even a healthy prebiotic one, would be facing an existential demand crisis.
Well, that is the logical assumption, yeah. But the source data reveals the exact opposite mechanism is at play here.
Really?
Yeah. The reports show that while 50% of GLP-1 users do indeed completely stop drinking traditional sugary sodas like Coke or Pepsi,
Okay, yeah.
25% of those users become acutely aware of their nutritional deficits.
Oh?
Right? Because GLP-1 medications drastically slow gastric emptying, so maintaining gut motility becomes a serious medical priority.
Oh, I see.
These consumers are actively hunting for ways to close their fiber gap.
So Olipop is functioning as a nutritional Trojan horse.
Exactly.
It delivers up to 9 grams of fiber per can, mimicking nostalgic flavors like root beer or vintage cola, but without the corresponding glycemic spike.
Right.
And because it solves a biological problem created by the GLP-1 drugs, it forms this super sticky behavioral habit. Even if users eventually cycle off the medication, the Olipop habit remains embedded in their daily routine.
It's a masterful behavioral pivot. I mean, when you evaluate this from a market mechanics perspective, a profitable private company generating $500 million in revenue while actively disrupting a century-old legacy duopoly,
It's huge.
is the exact profile of a massive future IPO. This is precisely where institutional growth capital hides when public consumer discretionary markets are failing.
That same principle of capital fleeing crowded, stressed environments
Yeah.
applies directly to our live public trading setups today.
Oh, definitely.
We have to look at the actionable levels and price anomalies because the rotation out of historically dominant sectors is accelerating.
Yeah, the defining macroeconomic overhang on the market this week is NVIDIA's upcoming earnings report.
Right.
The anticipation is creating this massive gravitational pull, which is resulting in a very intentional algorithmic rotation out of the broader semiconductor sector.
And we can see that weakness playing out in the semiconductor ETF, ticker SMH. The price action is intentionally sliding down to fill a technical gap at 545.46. Let's talk about the psychology of that gap fill real quick.
Yeah, let's do it.
For anyone looking at a chart, a gap represents a literal vacuum in the order book. It's a jump in price from a previous session where no actual shares changed hands.
Right. And we know markets abhor a vacuum.
Exactly. Algorithmic trading systems are programmed to hunt for these low-volume pockets, retracing the price to essentially fill the empty space and test if there's any real buyer demand at those levels before establishing a true trend.
And that mechanical retracement is exactly what we're seeing in the broader NASDAQ index as well.
Yeah.
The QQQ has a massive low-volume gap waiting to be filled between 707.53 and the psychological whole number of 700.
Oh, wow.
Yeah. Institutional traders are heavily monitoring the order flow at 707.53. If the bid support breaks there, the algorithms will likely trigger a rapid, just straight-shot liquidation down to 700 to fill the void.
So while semiconductors and the broader NASDAQ index are technically vulnerable and filling their gaps, that institutional capital has to be deployed somewhere.
Right. It doesn't just sit in cash.
And the sources point directly at a massive rotation into software, with Palantir, ticker PLTR, acting as the primary vehicle.
Yeah, Palantir's relative strength in a weak, broader market is immense right now.
It really is.
The crucial actionable level identified in the data is 176.50.
And the mechanics of why 176.50 matters is key here. It represents a reclaim of the previous day's absolute high.
Yep.
When a stock reclaims a high like that in a weak market, it forces short sellers who place their stops just above that level to cover their positions, which effectively triggers algorithmic buy orders that fuel upward momentum.
It acts as structural confirmation. Holding above 176.50 signals that institutional buyers are aggressively stepping in and absorbing supply at higher valuations.
Right.
And this ties directly back to the 42 macro risk management principles we discussed earlier.
How so?
Well, a disciplined trader does not blindly buy the gap down in the QQQ, hoping to magically catch the absolute bottom.
Right, the Steph Curry shot.
Exactly. They wait for a software proxy like Palantir to reclaim a critical resistance level, or they wait for the QQQ itself to reclaim its VWAP.
The volume-weighted average price, which is the exact metric institutional algorithms use to grade their execution.
Yep.
Waiting for the price to cross back above that VWAP line is how you avoid the type 2 error we talked about. You let the market structurally prove it wants to go higher before committing capital.
Absolutely.
Now, we've broken down gold, we've analyzed the software rotation, but the most aggressive, explosive rotation in all of our source material today is happening in the crypto sector.
Oh, the crypto outperformance is undeniably the most bullish structural read in the data.
Yeah.
The metrics indicate a massive trend shift.
I mean, the scale of the capital flow is staggering. The data highlights a massive $2 billion weekly inflow into Bitcoin.
Yeah.
That is the single largest institutional inflow we have seen since May.
And the technical setups across the major tokens mirror that volume perfectly.
Okay, let's hear them.
Bitcoin is establishing concrete support above the 70,000 level.
Nice.
Ethereum is fiercely defending the 2,000 mark. And Solana is holding a critical battleground at the 80 level.
And the significance of Solana holding 80 is that it represents a breakout from a multi-month accumulation zone, right?
Right.
Where institutions were just quietly absorbing retail supply.
Exactly. Furthermore, all of these assets are now trading above the daily Ichimoku cloud.
Oh, right. And breaking above that daily cloud is a massive technical trigger.
It is.
The cloud essentially visualizes momentum and dynamic support by plotting the midpoints of historical highs and lows. When an asset crosses above it, quantitative models interpret it as a definitive structural shift from a bearish or consolidating trend into a high-conviction bullish environment.
Right. It signals that the institutional friction and commercial short positions that previously suppressed the price are basically capitulating.
But let's look at the practical application of this.
Okay.
Because a lot of institutional equity funds, or even retail traders operating in traditional brokerage accounts, they cannot or will not set up cold storage wallets to hold altcoins like Zcash or Cardano directly.
No, of course not.
But the sources highlight that the smart money is capturing this crypto surge through traditional equity proxies.
Right. The proxy trades are where the highest concentration of day trading liquidity is flowing right now.
Okay, so what are the tickers?
Well, the reports explicitly highlight Robinhood, ticker HOOD, as a primary vehicle.
Got it.
The actionable setup there is monitoring for a confirmed reclaim of the daily VWAP and holding structurally tight within the 106 to 108 consolidation zone.
It's a classic break and retest technical setup.
Yep.
The sources also highlight Coinbase, ticker COIN, which is defending its previous day's high of 191, establishing a higher low structure.
Mm-hmm.
And finally, Circle is catching massive institutional bids right off the 87 level.
So when you have multiple equities operating within the same sector, perfectly defending their daily highs and absorbing sell pressure, it validates the broader macro rotation.
Right. Capital is aggressively utilizing these equities as a backdoor to capture the underlying crypto momentum.
Exactly. The interconnected nature of these rotations is what defines a shifting macroeconomic map. I mean, the traditional channels of capital are being systematically erased and redrawn in real time.
Wow. When we synthesize this entire journey, the through line is incredibly clear.
Yeah, it is.
We started by dissecting the mechanics of the Treasury's multi-billion-dollar debt buybacks and the resulting compression of real yields.
Right.
We mapped how political volatility and trade uncertainty are driving algorithmic capital into historic distribution zones in gold.
Mm-hmm.
We analyzed the grim economic reality of the middle-class consumer at the $5 bin store and juxtaposed it against the explosive profitable growth of Olipop, solving the GLP-1 fiber gap. And then we drilled all the way down into the psychological gap fills in the NASDAQ and the massive $2 billion institutional inflows lighting up the crypto proxy equities.
I mean, every single one of those data points confirms that the consensus view of the market is currently obsolete.
Completely obsolete. As we close out this deep dive, there is a final synthesized concept from the source material that I think demands attention.
Oh, absolutely. Because throughout the data, we noted highly unusual options, volume spiking in biotech and healthcare equities like Moderna and Tem.
Right.
And concurrently, we spent time analyzing the massive behavioral and biological shifts driven by GLP-1 medications, which companies like Olipop are already capitalizing on.
Yeah.
But right now, global capital is hyper-fixated on artificial intelligence solely through the lens of semiconductor hardware.
Right. Everyone is just waiting for the next NVIDIA chip.
Exactly. But what if the market is entirely focused on the infrastructure phase, while the actual generational wealth transfer is quietly moving to the application phase? What if the defining trade of the next decade isn't the hardware powering AI, but the convergence of artificial intelligence, advanced biotechnology, and everyday consumer metabolic health?
That's a crazy thought.
I mean, imagine an AI architecture capable of designing personalized prebiotic or synthetic biology therapies based on your specific response to a GLP-1 compound.
Right.
The hardware infrastructure is already built. The incoming capital rotation is likely targeting its application within human biology.
That is a staggering application. The map isn't just shifting. It's revealing entirely new continents of structural growth.
It really is.
To everyone listening, as you navigate this rapidly rotating market, demand structural confirmation before committing capital. Keep questioning the consensus, monitor the mechanics behind those low-volume gap fills, and whatever you do, stop trying to shoot Steph Curry half-court shots with your portfolio.
Please.
Let the market prove its direction to you. Until next time.